Friends, I welcome you all to our today's session. By this time, we have got some basic idea how to arrive at the value of a company or value of or enterprise value of a company by following market approach. Okay, one particular model we have tried earlier. Right now, we'll be learning one more concept. Concept means we'll be talking about various types of value that we deal with when we evaluate a company. That is what we are going to learn. And also we'll be learning again some practical application skills of this thing, market approach. So let me share the screen with you right now. Okay, we'll be seeing how market application will be applied and what are the types of value and some specific definition kind of thing we also need to understand that will help us to get a fair idea that what is valuation is all about. I request some of you first to read this particular definition, which is provided in the ICA Valuation Standard 103, Valuation Approaches and Methods. That is the name of the standard. That standard, in fact, defines what is business valuation. Will some of you read this particular definition?
Business valuation is the act or process of determining the value of a business enterprise or ownership interest therein.
Yes, friends. That means when we talk about the business valuation in general, we are talking about two things. It may be the valuation of the business enterprise or the ownership interest. Ownership interest means, let's say someone is holding 50% equities. He may be interested in the value of the equity. He may not be interested in the value of the entire business. Right? So it may be value of the equity or it may be the value of the entire enterprise. The process through which we arrive at the value of the business or the value of the ownership interest is referred to as business values. So it is a process. Various methods are there, various approaches are there through which we follow this process and arrive at a value. Okay, so this is the defined, this is the definition which is given. And you are aware of that ICA valuation standards, that is the valuation standards which are issued by Institute of Chartered Accountants of India, has identified three approaches. And international valuation approach valuation standards also suggest the three approaches. One is, can you name these three approaches?
Market approach, income approach, and cost approach.
Friends, the relative valuation model that we have learned in the previous session was a part of this market approach. Okay, and under that you can see market price approach, comparable companies multiple method approach, comparable transaction multiple method approach. That means we are using certain multiples to arrive at the value. Right. So today we'll be again practically saying how to do it. And since right now we are studying about the market approach, what is market approach? That has been defined in International Valuation Standard 105. The name of that standard is Valuation Approaches and Methods. Okay, so International Valuation Standard defines market approach in this manner. I again request some of you, please read this definition.
Of course. The market approach provides an indication of value by comparing the asset with identical or comparable assets for which price information is available.
Right. So if you are following the market approach, internationally recognized market approach, first we need to identify what is that asset we are going to value. Are we going to value the entire enterprise? Are we going to value the business? That is important. Okay, what are that we're going to value? First, let us identify what is that we're going to value. That asset might be the entire business, or asset might be an equity. Then we also need to find out comparable asset. That is similar asset. The same kind of asset we need to identify. Okay, and we will be selecting similar assets in such a way that price information is available for them. Okay, so practically in the previous session, when we are doing the valuation, we have selected some companies for whom price information is readily available. Is it not? Because we'll be comparing. For comparison, we need information. If information available, those companies will be selected. But always ensure that they are comparable assets. Okay, how you will know that comparable assets? Suppose you are selecting a pharmaceutical company. So you have to also select comparable companies. Okay. While doing the comparison, also keep in mind their size. What is their balance sheet size? What is the turnover? Okay. Whether it's listed or unlisted, all these things you have to take into consideration. Not that just like you will select 20, 30 pharmaceutical companies and you will take that data and average it or average of that data and use their multiple. Okay, that should not be there. We should take utmost care to ensure that the companies that we're selecting as comparables are really comparables. They are similar type of companies. Okay, so that is important. There we have to apply your mind. Right, friends?
Yes.
Okay, so next time when you are following this particular approach, ensure that the companies are actually identical or comparable. Okay, and on what basis you are concluding that these are the comparable companies? So you need to document that thing also. So you may select 20 companies, out of which you may reject 5 and select 15. And why you are rejecting these 5 companies, you may justify because they are not comparable. Even if they may be belonging to the same sector, but still they may not be comparable. Okay, so this is what is market approach as defined in the international valuation standard. Now coming to our ICI valuation standard, there also market approach has been defined. Okay, here it says this market approach means use of market information of similar assets. That means if I'm using market information and of similar assets, then you can call that approach as market approach. So here it says the market approach is a valuation approach that uses prices and other relevant information generated by market transactions involving identical or comparable or similar assets or liabilities, or a group of assets and liabilities such as business. Here in essence, what it says is that we need to use market information if you are following a market approach. Okay, that's what we have done there also. And under one of the model that we have followed, that under market approach, we have seen that under relative valuation models. Relative valuation model is in fact one of them. Right. And these models are used to value companies by comparing them with other businesses based on certain matrices. And these certain matrices that we have used number of matrices. Normally, these are the matrices we use. We can compare the revenue multiple, EBITDA multiple, PE ratio multiple, price to book value ratio multiple, earning per share multiple, cash earning per share multiple, operating profit margin multiple, and net profit margin multiple. These are the something we have tried. Okay, which multiple is relevant? You should again apply your mind, and on that basis, you need to decide. Understood?
Yes.
About relative valuation model, and we have already used all these models now. Okay, and in this context, we have to also see that when you're talking about business valuation, we have to deal with various types of it. Okay, it might be valuation means it might be the value of the entire entity, or it might be the valuation of shares, or maybe shareholdings. Okay, when you coming to shareholdings, a person might be having controlling interest, somebody might be having non-controlling interest. And also sometimes One type of value is about the valuation of specific business activity. Okay. So we need to understand all these types of value that we are talking about. Okay. Roughly, if I talk about, when you say value of an entity, what is coming to your mind? Is it value of the entire business or value of equity alone? Entity valuation. Are you getting my question?
Not really. Can you repeat?
My question is that when you talk about entity valuation, am I talking about value of equity or the entire business?
Entire business.
Entire business. Okay. So exactly we'll be understanding what is that enterprise value at the latter stage. But when you talk about value of shares, what I'm talking about equity values. And friends, basically at very basic level, try to remember the business value means value of the debt as well as value of equity, both taken together. Right? Because the capital comes from these two sources, debt and equity. If you take both the things, then only you will be getting the enterprise value subject to some other adjustments. That will be also certain other adjustments are also there that again we are going to learn. But when you're talking about share value, I'm talking about maybe equity value, maybe preference share value. Okay. When you talk about shareholdings value, we're talking about the specific person's shareholdings. What is the value of his holdings? Share value might be different, and the value of his holdings might be different. For example, let us say someone is holding only 1% share in a company. Another person is holding, let us say, 49% share. Or others remaining shares are sold by some other person. Okay. Now let us say for a person who is holding 49% of the shares, for him, the value of 1% share is definitely much more than from any other person. Because he may feel that if I acquire 1 more percent, I will be able to control the company. At least 50% share will be with my name. So that if any decision, let us say in a general companies, AGM, some decisions are taken. So he may be the winner in that decision. Because he'll be controlling almost 50% of the vote. Is it not?
Of course.
Okay. So the value of controlling interest is different. Sometimes what happens, if there's some person is evaluating his own holding, if it affects the controlling interest, so some premiums are also charged. Because through this acquisition, one will be getting some controlling interest. He'll be able to control. Right? Are you getting my point?
Yes, sir.
Okay. So that aspect also needs to be kept in mind. Shareholdings valuations are different. Share valuation is different. And value of business interest is someone is having a certain interest in the business. That's a 10% interest, 20% interest. Okay. Or maybe he's interested commercially. That interest can also be separately valued. That is the value of business interest. Similarly, separate business activity can also be separately valued. Okay, suppose there is a company who has multiple activities. Let us say he's in media sector. He's having print media. He's having electronic media. That specific activity, let's say print media, may be separately valued. This times happens many times. Companies are formed, they do business in various sectors. Then after that, they split. And they're split into two different companies. So a particular activity is valued. Okay. So that to decide how this thing, let us say swap ratios will be arrived at. Okay, are you getting my point? Suppose a company is involved in two activities. Now it wants to do a kind of split up and two separate companies have to form. So we need to evaluate each of these activities. On that basis, we'll be deciding what the swap ratio and shares will be distributed. Are you getting me? Right. Now, when you're learning about these types of value, entity valuation, share valuation, shareholder valuation, business interest valuation, business activity valuation, we have to see that what is the type of value which is relevant or which is appropriate to the purpose. And that also should be mentioned in the valuation report. That this is the type of value which is appropriate. Okay. The above content which I'm showing you on the screen right now is taken from International Valuation Standard 200. That is businesses and business interest. So here it says that the type of value being provided must be appropriate to the purpose of valuation and communicated as a part of scope of the engagement. In the report itself, that should be mentioned. Why it is to be mentioned? Because it is really critical, specifically when the business or business interests are valued. Okay, because at different levels, value may be different. Suppose someone is acquiring, let us say 49%, that business interest value might be different from a person who is acquiring, who is having 50%. Are you agreeing to it? At different levels, value might be different. Business interest. Someone is having, let us say, business interest of 25%. He is having 25% shareholding in a company. Okay, so that value is definitely got some premium, because if someone is having 25%, he will be able to control almost all types of special resolution passed by the company. Okay, because 3/4 majority will not be possible without his consent. That means he's controlling all the special resolutions, isn't it? Wherever special resolution is required under the Companies Act, it is under his control. Only when he wishes, then it will happen. Otherwise, not. Isn't it? If someone is holding, let us say, 50% business interest, now he is able to control all ordinary resolutions also. Okay. Are you getting it? Or let us say someone is holding 75% of holding, he can control all special resolutions. Because without taking other person's consent also, he can pass special resolutions. So this percentage is like 10%, even 5%, 5%, 10%, 25%, 20%, 50%, 75%, 90%. These are the holdings which matters. This type of this size of business holding, let us say business interest matters. Matters means matters for controlling interest. Are you getting me?
Yes, sir.
They deserve some kind of control premium. Okay. Suppose many cases Companies Act requires 90% majority. In the case of 90% of the majority shareholders agree. So if the person is holding 10%, he is controlling that decision. Okay, some situation we need, let's say 20%, 25%. Some situation we need 20%. Some situation we need 50% to control the decision. Then 75%, then 90%. So this type of controlling interest will definitely invite a premium to arrive at the value. So that also needs to be taken care of. So even if we are following market approach, one need to adjust it. Okay. Now, first we're talking about, when we're talking about some of the types of value, these are the various types of value we have discussed just now. First one is, you see, enterprise value. You can look at this chart. We'll be now talking about these 4 types of value. One is enterprise value. Second, we are talking about total invested capital value. Third one is operating value. Fourth one is equity value. These are the 4 types of value now we'll be talking about. And this is, we are discussing with reference to the international valuation start at 200. What is enterprise value? Now, if we read it, this is extremely important for us. In the previous model, we have tried to arrive at the enterprise value, but that is not yet completed. Now, after reading this thing, you'll be able to understand what is wrong in that model and how one can adjust. Can you read it?
Okay.
One can improve it. What is enterprise value? Please read it now.
Enterprise value, often described as the total value of the equity in a business plus the value of its debt or debt-related liabilities, minus any cash or cash equivalents available to meet those liabilities.
Okay. So if we really want to arrive at the enterprise value, first we need to arrive at the value of equity. Okay, when we applied the model in the previous session, we arrived at the value of equity, in fact, because we have taken the total market capitalization, full market capitalization. That in fact presents value of equity. That will be treated as enterprise value provided there is no debt. If the company you are valuing, if it is a zero debt company, then what you have done, that is right. But in case debt is there, then you need to add the debt value also, because the value you have calculated, that is in fact the value of equity. Okay, and in addition to that, okay, plus the value of liability minus any cash or cash equivalent. When you're having cash, that means that cash is not used in the business. So to arrive at the value, we need to remove that thing. So now if you look at hereafter, I think you can make improvement in that model. That when you're talking about enterprise value, you have to take what? Value of the equity plus value of debt, then minus, what is that we're deducting?
Cash equivalent.
Cash and cash equivalent. Okay, where it is suggested? It is again suggested in the International Valuation Standard 200, which talks about businesses and business interest. So this enterprise value, often described as the total value of equity in the business plus the value of its debt or the debt-related liabilities minus any cash or cash equivalent available to meet those liabilities. Okay, suppose I'm having liability and there is a cash balance. That means this much of cash balance is available to meet those liabilities. So that cash balance needs to be deducted. That means that cash balance beyond the operating needs. Suppose to run the business, I need some cash. That is there. But extra cash I am having, that is in fact not used for the operation of the business. That can be used for settling the liability. So equity value plus value of the debt minus cash or cash equivalent available to meet this liability. You'll be getting enterprise value. Are you getting the point?
Yes.
Okay. Right. So now how you might be thinking, okay, that's okay. I have arrived at the value. That can be the right value provided there is no debt. But if there is debt, what I should do? Then you have to make this adjustment. You might be thinking how to arrive at the value of the debt. Because now we have understood when we talk about the value of the business, it involves both value of equity as well as value of debt. So how to arrive at the value of debt, I'll be telling you after some time. Now coming to next type of value, That is, you see, total invested capital value. Okay. Here, what is this? This is the total amount of money currently invested in the business, regardless of its source, often reflected as the value of total assets less current liabilities and cash. Here, friends, we are talking about total invested capital value. That means how much capital is invested. In fact, we're talking about the capex. What is the capital expenditure? How you can find out? If I deduct from the total assets, you see the entire investment is made in two forms. Is it not? What are they? Current assets or non-current assets? So from the total assets, if I'm removing the current part, what remains is my capex. Yes and no. In fact, that represents the total investment made in the business.
Yes, basically equity plus your non-current assets.
Equity plus, if you talk from the asset side point of view, it is only non-current assets.
Liabilities, not assets.
Okay, right.
Yes,
So that's what
total
we're
assets
saying.
minus current liability.
Yes. That's why you're saying that the total amount of money currently invested in the business. Okay, how to know it? The total assets less current liabilities and cash. Okay, that is what we arrive at. Now, if you see how to arrive at the total invested capital value of the assets minus current liabilities minus cash and cash equivalent. Okay. Now, are you getting this point? Or should I explain it once again?
Got it.
All of you got it? Total invested capital. Total asset minus current liabilities and cash. So if I understand it like this, when we talk about total asset, that is same as total liabilities and equity. Is it not? From that, you are deducting current liabilities and cash. So what remains with you? Non-current assets as well as current assets. Are you getting it, or should I explain you again?
I got it, sir.
Got it? Okay, fine. Now, next type of value is operating value. That is the total value of the operations of the business, excluding the value of non-operating assets and liabilities. Here, if there is some non-operating assets are there, but that are not used in operation, and liabilities are there, that needs to be removed from your total value, from the total asset value. That is called as the operating value. Okay, how to arrive at the operating value? Value of operations minus non-operating assets. And if there is some non-operating liabilities, that will be added. Both the things has to be ignored. So assets is to be deducted, liabilities is to be added. Okay, both operating assets and operating liabilities have to be ignored. How to exclude? Asset has to be reduced, liability has to be added. That is how we can exclude.
Value of operations minus non-operating assets plus non-operating liabilities. Value of operations is what?
Value of operations means you need to value, let us say, the cash flows which are generated from these operations only. For example,
gross profit.
Gross profit. Not exactly gross profit. We have to do some adjustments. Okay. For example, let us say you are having a business, right? And for the operation, you are earning some revenue, and plus something you are getting some non-operating income. Let us say you are receiving some rent from a building, Okay, that is not your business appraisal, but they are reflected in the financial statement. Okay, and because of that thing, your business value is different, but that is not your operating value.
Okay.
Are you getting?
Yeah. So
Suppose you got some asset, which is not used for appraisal. So that needs to be removed.
Okay. Of course.
Right? Okay. Understood now?
No, sir, not really. I still don't know value of operations. May what you have to remove.
Okay. So first, let me see. Let us read it for you once again. First, you see, we need to arrive at the total value of the operations of the business. So your query is that how to arrive at this thing. The non-operating assets liability, you have understood.
Yeah.
Right. Now, first of all, the value of the business operations, that is your query. Okay. Now, let me try to help you this thing. This particular point is coming to your mind because we have not only one method of valuation or one approach, that is market approach. Now you see, business operation that means value of business operations are normally lower than the total business value. Total business value might be 5 crore, maybe business operation value might be 4 crore. Just an example I'm giving. Why it is so? Because the business might be generating some non-operating income, or might be having some non-operating assets. So those things needs to be ignored. How it is possible? Let us say there is a media company whose due is to do some kind of programs in electronic. So that is his operational income. Yes or no?
Operation from revenue, yes.
Yes, that is totally operational income. So we can consider the cash flows and arrive at what is the value of that operation. But the same company having some non-operational assets, which is not his business assets. It is, of course, company is the owner of that assets, but that has not used for the business.
Okay.
For example, let us say if that company is having a big building where rent is generated. That rental income, is it an operating income?
No.
No. Or let us say that asset is there appearing in the company's balance sheet, which is not used for business operations. It is used for some other commercial purposes and rent is generated. Income is generated. Company is having income. Now, when you are arriving at the operating value, I need to ignore that.
Of course.
Okay. So that is what we call it as the operating value. Are you getting the point now?
Yes, I understood.
It depends upon the purpose. Suppose a media company needs to be acquired by another media company. He'll be interested in evaluating your operational income. He'll be interested in your operational value. He's not interested that all other kind of income you're having.
Got it. Yes.
Got it. Because he's focusing on your business. So he may not be interested with your entire business value.
Okay. So the operating value.
Yes.
Operating value of operations.
Yes.
Does it, it's a value, correct? It's a value. And
Yeah.
is our expenses deducted from that? Or is it just the revenue?
No, I couldn't get it. Will you please repeat your question again?
So the value of operations is a number.
Yes, it's a number.
It's in rupees, obviously.
Yes.
And so that number is our expenses.
No. The value is not expenses. Value is not income.
Okay.
Value is valuation of a particular asset or liabilities we are talking about. And here in this context, we are talking about the asset. The asset may be the business.
Okay.
Okay, that is what you are value, not expenses, not income.
So we're talking about assets which are used in operations to generate income.
Yes.
Okay. Got it.
Right. But how to arrive at the value of asset? One thing is that you can take book value. Okay. Or you may do one more thing. That is what, when talk about the value of operations, since only one method we have learned, it might be appearing little confusing to you. Now let us say business income, operational income, you may project it. Okay, so present value of that cash flow is the value of business appraisal. Now income is converted into one number. Income is a stream, but I am not interested in that stream. I want to know the value. That means I want to know a single number. How to convert a stream of cash flows into single number?
You discount them.
Present value of all these cash flows.
Yeah.
Yeah, that's right.
Okay.
So it's not necessary that you should take book value. If you're having income, then try to arrive what is the cash flow associated with that income. Then you can get it discounted and arrive at the present value.
Okay.
Got it now?
Yes.
Okay. So after when we learn the other methods at this time, at that point of time, it will be more clear to you how to arrive at the value of a piece. Okay. Now, friends, last type of value is equity value. Here we are talking about, let us first arrive at the value of the business. Therefrom, we are going to deduct that what is the value of business to the debt holders. After that, we will be getting the equity value. Okay. Suppose we arrive at the total value of business is this one. But debt holders own some money. That needs to be deducted. After that, we will be getting the value available to the equity shareholders. We call it as the equity value. Is it clear to you? 4 types of value. Yes or no? Are you getting these values?
Yes.
Okay. And this, Archie, please remember that these are not the exhaustive list of 4 types of value. IPS 200 says these are the examples, that these are the possibilities. The different types of values are possible. Enterprise value might be different. Total invested capital value might be different. Operating value might be different. Equity value might be different. There are many other types of values that are also possible. So these are only examples given to you. Okay, now from that international standard, if I move from that standard to our Indian standard, right? Now I am taking you to the standard 301 of business valuation. ICA Evaluation Standard Para 11. Now please read this particular point, which is important for us.
When valuing a business or business ownership interest, a valuer may express either an exact number or a range of values.
Yes, friends. Either an exact number or a range of values. Friends, last time when we applied that model, did you get a single value or you got a varieties of value? And you find out there is a big difference between them. Is
You
it
got
not?
a range, yes.
You got a range. So it is not necessary that valuer will arrive at a single number. It may give a range that the value of business might be from 200 crore to 450 crore. It may give a wide range like this. Okay. Or you can evaluate something like this. Optimistically value is this much, pessimistically value is this much. Or sometimes we do in different scenarios. Like best scenario value is this much, worst scenario value is this much. And what is the value in the most likely scenario, that also one can arrive at by giving weightage, different weightage to different scenarios. Okay, so don't think that value will be a single number. It's not arithmetic. Therefore, the standard has clearly said this, that value can be a single number if valuer is confident that this is the number which will really reflect the true value or which will reflect the fair value. Otherwise, he has got a choice to give a range of value. Okay. Right?
Right.
Now, let us say, I told you IVS has given these 4 examples. of types of value. Indian valuation standard is giving you these three types of value. Here it talks about the benchmark of value. The para 11 of ICA valuation standard says there could be different benchmarks at which estimate of value of an entity could be expressed by the valuer. The valuer may say this is the value, but this is enterprise value, or it may say this is business value, or it may say this is equity value. So if you first read the first definition of ICA valuation standard, you'll find this is more or less similar to the international valuation standards definition. Now, please read it. Enterprise values definition. It's here.
Enterprise value is the value attributable to the equity shareholders plus the value of debt and debt-like items, minority interest, preference shares, less the amount of non-operating cash and cash equivalents.
Okay. Here it says that we need to first arrive at the equity value. Plus, we are going to add the debt value. That means the business value is both equity value plus debt value. And there might be some debt-like items that, let's say, minority equity is just like a debt. That means you can pay back, they're not controlling. Or if there is some preference share, so that preference share value can be arrived at. Okay, so we can find out it is the value attributable to the equity shareholders plus value of debt and value of like items like minority interest, preference shares, all these things has to be added. Then we'll be getting the total business value minus non-operating cash and cash equivalents. Cash and cash equivalents, non-operating means they're not used in business operation. So that part of cash and cash equivalents needs to be excluded. That is what enterprise value is. Any query you have?
No.
All of you got this point. Enterprise value.
Yes, sir.
Value of equity plus value of debt. And equity also includes minority interest. And preference share, typically preference shares behaves partially like equity, partially like debt. So that has to be separately valued. So all these values has to be arrived at. Then non-operating cash and cash equivalents needs to be deducted there. This is enterprise value. What is business? Yes.
How would you explain what is minority interest?
Okay. What is minority interest? Okay. So technical definitions will be discussing later on. But normally in this context, if let us say someone is holding 90% of the shareholders can be considered as the majority shareholders. And all people total amounting to, let us say, 10% can be considered as the minority shareholders. How it will be defined later on, an appropriate time, I'll be explaining it. Okay, but when you're arriving at valuation, if you find out something like this, some people or a group of people or some promoters are holding 99%, or 1% is held by somebody else, you can 100% call it as the minority interest because all the decisions are taken by other people.
Okay.
Why they are called as minority interest? Because they don't have any practical stake on decision.
Right.
Right. Suppose the shareholders decide to close the company. Then 90% of the shareholders can take decision that treat the other shareholders as minority interest and settle that, let us say, dues.
Okay. Got it.
Okay. So under different law, there are different ways of definition of minority interest. But here, when coming to the valuation, we have to see if a particular group or a particular investor, particular equity shareholders is unable to control the company. We can call it as the minority interest. Okay, what I feel that if a person is not holding, or the group of persons is not holding at least 10%, they may not be able to control the company. They cannot to take any decision. Okay, so likewise, you can define what is minority interest. On what ground you are saying this is minority interest, you may define.
Why is the word interest there? Minority interest, like what does that interest mean?
Interest means they have a stake in the company.
Okay,
But
okay.
that's why from that ground it is minority, and then it's called as minority interest. Okay, right. Is it clear to you?
Yes.
Now, coming to next type of value, that is business value. Business value is the value of business attributable to all its shareholders. That means all types of shareholders. That means we are not considering about the debt. Okay. So what is the value of the business to the shareholders is the business value. When you talk about the next type of value is equity value, it is the value of the business attributable to equity shareholders. Right. That means preference shareholders value needs to be ignored. So now you can see, we can value it at 3 stages. Enterprise value means everything is taken into consideration. Business value, debt holders are ignored, only value to the shareholders are taken into consideration. Equity value, only equity shareholders are taken into consideration. And from their point of view, this equity value is to be arrived at. Okay. Got it? Or there is some confusion? Got it? These 3 types of values as per ICI valuation standard. And in case there is no debt holder, then the values might be same, or there is no preference share. The business value, equity value may be same. Right, friends? Now,
Yes.
let me move to the next practical concept, what we have learned in our previous session. Friends, you see, so these are various multiple or various criteria or parameters we have used to arrive at the value of a company. How we have done? We have on the basis of revenue, EPS, CEPS, P ratio, PB ratio, EBITDA, then ROE, then operating margin, then net profit margin. On that basis, we arrived at, and we relating this thing with the market capitalization, this full market capitalization, we arrived at the equity value. But now today I am telling you one more thing. What you arrived at, that is in fact the value of equity. You need to arrive, you need to add what? What is to be added? Are you getting it? What is to be added?
Value of debt needs to be added to equity value to make
To arrive at the value of business. Then
we deduct cash.
non-operating cash needs to be done. Then you will be getting the value of business. Okay. So this is normally we are supposed to do to arrive at the value of business if you're following this approach. But one more thing. The companies that you have taken as sample, are their equities are marketable? That means whether they can be freely traded at any point of time. Yes or no?
Yes, sir.
Yes. Why you are saying so? Why you feel that it can be traded easily at any point of time? Because they're listing, is it not? Yes or no? Please keep on responding. They're listed or not? The equity shares are listed. You have collected data from the stock exchange site, right?
Yes, sir.
Yes. And the company that you are valuing, is it a listed company?
Yes, sir.
If it is a listed company, that's so. But in case it is not a listed company. For example, when I was showing you that example, I had taken a company which is not a listed company. It is a private limited company, not listed. And you know, in case of private limited company, the transferability of shares are restricted. Shares are not freely transferred. Is it done? So by its articles, share transfer is restricted. So therefore, when we are comparing a private limited company with some listed company, when you arrive at the value, if you want to arrive at the fair value, we need to discount that value, which is arrived at by using these multiples. That type of discount is called as discount for lack of marketability, because my sample is marketable, but the company whose business I am valuing, the whose equity shares I am valuing, is non-marketable. Are you getting it? So therefore, I need to allow a discount which is called as discount for lack of marketability. So this is again one more adjustment you have to do. Once you arrive at the market capitalization, or you can say value of equity, then let us allow some discount for lack of marketability. Are you getting? This discount will be allowed when the shares or business that we're valuing is not marketable. Marketability increases the value. If shares are not marketable, then appropriate discount needs to be given. Are you getting me? Yes or no?
Yes, sir.
Okay. Is there any question in your mind? Okay. Now, this question should come to your mind. Okay, fine. I've done everything, but how to arrive at this discount for lack of marketability? How to calculate that thing? That is really a big challenge. At what rate you are going to discount? 30%, 40%, 50%, 60%, 70%. Can you think of something? Can anyone tell me? At what rate you are going to discount? It's really difficult. So various authors, internationally reputed authors, suggested some range which may be around 30% to 70%. You may give as discount for lack of marketability. It is again the professional judgment of the value. He has to see that how much discount he can give depending upon the situation. And a professional valuer, when values, he normally gives some record that on what basis is he allowing this type of discount. Okay, many times we see discount for lack of marketability are given. Okay, Would you like to let me show you some valuation report again right now? Just give me a second. Friends, just see, I'm showing you a valuation report. I can show you how discount for lack of marketability is adjusted. Finally, if you look at the value of this company when it's arrived at, uh, final calculation, I would like to show you. Just give me a second. It is not there in the main report. It is there, but it will be there in the calculations. No, in this company, it is not given. Friends, I'm showing you this report where discount for lack of marketability is given. If you see these calculations, it is of course on a different approach. It's a cash flow projection approach. You see, are you able to see it on your screen? Some calculations are there.
Yes, sir.
Now you see here what has done. Some business value is arrived at with some figure. Okay, in lakhs, then it crores, then some immediate liability is deducted. Company was supposed to pay some liability. Then cash and cash equivalents are added here, right? Then premium, there is no premium because control issues are not there. Adjusted values are arrived at. And then you see in this line, you see discount factor for lack of marketability, 0.3. That means 30% discount is given. Okay, here cash and cash warrant is added because for this purpose, it was considered that this is an asset for the business and that needs to be used. So that is added. And discount for lack of marketability, you see 30%, that means 13.31 is deducted. After that, adjusted enterprise value has been arrived. Got it? Why this discount for lack of marketability is given? Because these shares are definitely not marketable. Since they are not marketable, the discount for lack of marketability is allowed by the value. It's on with the basis of his judgment. Now the question comes whether it be 30%, 40%, 50%. As I told you, internationally it's accepted from 30% to 70%. It may go. It may be less than that. It may be more than that also, depending upon the situation. But to know that thing, normally what evaluator is supposed to do, that he can see if there is some issue in the recent past. One can find out what was the value prior to issue, prior to listing. Let us say some listing has happened recently in that sector, another company. It can compare what is the price before listing, what is the price after listing. That means because of listing, that means when equity share is becoming marketable, it is commanding more value. By comparing these two, one can arrive at what should be the discount for lack of marketability. Are you getting my point? What I said. This is just an guideline I'm giving you. On that basis, you can decide what should be the appropriate rate for discounting, for computing discount for lack of marketability. Okay. Got it? Are you getting me?
Yes, sir. Yes, sir.
Yes, sir.
Yes. Now, friends, uh, when we are coming to income approach we'll be learning in detail. But right now, since we are in the process of learning how to arrive at the value of debt, how to discount the cash flows with this thing, taking into consideration lack of marketability, there are two more types of value, which is called as enterprise value or equity value. And what are the appropriate discount factors which are applicable? Let us learn that thing here. And these two methods I am talking about is about income approach. Income approach means under this approach, the firm evaluates the cash flow, that is value of business is arrived at on the basis of cash flows. Okay, one has to see that what is the future cash flow that needs to be discounted. On that basis, you may arrive at the enterprise value. Here, if I refer to the International Valuation Standard 200, it says enterprise value is typically derived by using cash flows before debt servicing cost. That means before interest. And an appropriate discount rate applicable to the enterprise cash flow, such as weighted average cost of capital. That means when I'm arriving at the enterprise value, at which rate I should discount the cash flows? What is the discount rate? Are you able to see it? See the picture? The appropriate discount rate is what? It is weighted average cost of capital. But when I'm arriving at the equity value may be derived by using the cash flow to equity, that is after debt servicing cost. Okay, so enterprise value before debt servicing cost and equity value after debt servicing cost, that is after interest value. And an appropriate discount rate applicable to the equity level cash flow, such as cost of equity. So if I'm arriving at the equity value, I need to discount at KE, that is cost of equity. But if I'm arriving at the enterprise value, I need to get the cash flow discounting as weighted average cost of capital. Did you get these points?
Yes, I got it. But what happens when we arrive at operating value?
What happens? We arrive at the
Operating value. Then how do we discount?
okay. Operating value, you can discount it at weighted average cost of capital.
Okay.
Now you see how you run the business like this. Do you use equity only or equity plus debt?
We use debt also. Okay, got it.
Then the entire capital structure, since it is applied for the business operation, you have to select the appropriate discount.
Yes.
Okay, so standards are in fact not rules. They are for guidance purposes. It says appropriate discount rate. So if you want to arrive at the operating value, the appropriate discount rate will be 1. But in case only equity is there, then obviously it is equity.
Okay.
Or if you can compute time value, then that is a better thing. That is a better discount. Okay, if you can compute time value money instead of weighted average cost of it. The challenge before computation of time value money is that you need to know rate of inflation, then what? How you will be able to compute time value money? At least you need to know what is the rate of inflation, what is the risk-free rate of return, and what is more important, you have to add the risk premium.
Risk premium.
Yeah, risk premium can be biased. So you may say 2%, somebody can say 3%. So that decision can be biased. That is the challenge.
Okay.
Okay. Because operating cash flows needs to be discounted at the time value money. What I feel that the cash flows will be realized over a period of time. Today's value needs to be arrived at real time. But since there is a possibility of bias in this computation of time value money, we prefer a better method, that is weighted average cost of capital. Okay. That gives us more comfort, not a better method, but that gives us more comfort. Okay. Now, on that basis, you have seen previous session, what we have done, we have seen, we have collected market data from various companies. Now you have understood how to select the appropriate sample, how to see whether these companies are comparable or not. You may eliminate some of the companies so that you'll be getting the real market data. For example, this particular slide, if you see, there is one company that is India Bulls Real Estate. Because of the presence of that company and because that company has incurred net losses, you see their balance sheet, you see the average NPM market is negative. NPM, average net profit margin is in percentage is negative. So this particular company may not be comparable company. Ideally, that should be removed. So this is something it should be coming to your mind. So market, when collecting the market data, ensure that they are reliable. Previous session, we have seen how to collect market. They're reliable or they're comparable. Okay, you see what is the data of the company which is available, which you are going to value, and see that you are taking comparable companies. Right. The last session, we have seen that this is the market data we have captured. Are you able to see it? We have averaged it out. Then we have found out what is the data for this company which is going to be valued. Then we have arrived at various values. Okay. You see these values has arrived. For example, if you have seen, let's say average EPS of the market is 11.62. For 11.62 EPS, the average market capitalization comes to 10,240. Right? And this company's EPS is 1,114. Or you can say 1153.57. So what will be the value? So value will be, formula is given here, I divided by A, this is column I, this is 29,079.49 divided by 11.62, multiplied with 1153.57. On that basis, we have calculated. But today I am saying this market capitalization is in fact the value of equity. It is not value of debt. So if your company is having some debt, then please add that figure, that value. You'll be getting the value of business. Got it, friends?
Yes, sir. Yes, sir.
Yes, friends. So some basic concept we have discussed. So we'll be continuing it. Today's class was mostly about types of value we have taught. And we have seen what kind of modifications are required in our the project we have done. So that all those things we'll be doing in our next session. Okay. You have any query? Any doubt you have? No doubt. Okay. Thank you very much. Let us catch up in your next session. Thanks a lot.